wanted to highlight. Raunak Onkar is with us, co-fund manager, equity and head of research at PPFAS Mutual Fund. Raunak, good to have you with us here. Good afternoon. Thanks for your time. Everything happens in double time, quick time now, unlike 10, 15 years back when, corrections could be grinding, long-winded, could take months. This is a quick service in that sense. Is it done, is the question though, Raunak? What's your sense? Is the excess out in that sense?
Thank you for inviting me, Prashant. And it's a very interesting question, which anybody can give any answer and it can sound right. So the problem here is it's very hard to predict. What we do, and we try to avoid predicting this precisely by just focusing on the businesses we own in the portfolio. So if a few businesses are doing okay, the valuations are reasonable, and they have a runway which we thought they should have over a period of time, then there is no reason to worry about whether there will be a broad correction, when it will happen, why it will happen. In fact, if it corrects and the business economics still remain the same, you can continue to buy at reasonable prices. So we do tend to keep a little bit of cash at hand when we think the valuations are a little heated. At the moment, we're at 13% cash in the portfolio.
So 13% cash, what was it, say 6 months back? Have you lightened your holdings in any of the mid and the small cap stocks over the last few months? And would you look to do a little bit more of that?
It would have been more or less the same range of cash in the portfolio. It wasn't dramatically different. Wherever we found a little bit of expensive valuations, we have trimmed. But otherwise, we have been adding wherever the valuations are still reasonable. So net-net, it's going to be the same.
You want to tell us where you've trimmed your holdings and what made it to the buy list to increase your weight?
It's the existing stocks we own. So some of the private sector banks is where we added a little bit. We also added to some of the smaller names in the portfolio earlier, which were high dividend yielding stocks. Some of the PSUs we added where we felt the valuation was still reasonable. And in the trimming list, there will be some cyclicals we had bought for special situation in the past. We have trimmed those. Something like NMDC Steel or NMDC, etc.
Okay, got that. Raunak, hi, good afternoon. I noticed that you continue your, big love with the HDFC Bank, right? I think it's still one of the big positions in both your portfolios, in the Flexi Cap as well as in the Tax Saver Fund, right? So what's the thought process? Because it's just been really trying investors' patience. So as money managers, I mean, you're still being patient. Have you added more, and sort of how do you deal with it from here on?
Deal with it is fine. It's very easy to deal with when you know that there is a period of adjustment they will have to do because of the merger that has happened very recently. We have to give them some time for the numbers to normalize. So that is one way of looking at it. The other way is to see whether the loan book is better or worse, say, compared to 5 years ago, whether the expansion of the branches that they're going to do is better or worse than 5 years ago, whether other initiatives like having the management aligned. So we have a change of management in the company of this size. Does it work out in the favor over a 5-year period? Some of these longer term trends are something we want to monitor rather than waiting for the valuation to keep going up in a short period of time. So yeah, patience is fine, but on the other hand, business metrics also should demonstrate over a period of time. So we will wait till the numbers either become better or worse and the valuations remain wherever they are based on the numbers.
All right. Hi, Raunak. Good afternoon and good to see you. When you're in the peers, you'll have added some of these private sector banks, as you mentioned, HDFC Bank, Kotak Bank, as well as, I think, ICICI Bank. All three of them, I think you'll have added some weightage in the last 1 month or so. The other big heavyweight that you'll had is ITC. And there was some weakness. The stock corrected close to around 20% from the recent peak in anticipation of this block. You'll have added on positions there as well, right?
In the past, we did, not recently.
Okay, all right.
ITC remains to be a big part of the portfolio.
Big part of the portfolio. And the other couple of names, I think, is EID, Parry, as well as Power Grid. Have you all added positions over there as well?
Yes, so Power Grid we have added maybe recently. EID, Parry also a while back we added. It started in the last couple of months only.
Interesting. One more point, Raunak, you all were playing, I think, the Bajaj story via the Bajaj Holdings. Over there as well, you'll continue to play the Bajaj Holdings. I think Bajaj group companies like Auto as well as Bajaj Finance via the holding company. Have you increased positions there as well, Bajaj Holdings?
So in the portfolio, we already had Bajaj Holdings as a very sizable portfolio position. But we also have Maharashtra Scooters as a small position. So yeah, we still do hope that the holding company discount is something that allows us to buy this at a cheaper valuation. And we do want to buy it through the holding company rather than buying the underlying.
Right. Just one quick point before we're going to talk about the I think you guys must also be busy with the stress test. Surabhi is going to sort of give us a heads up in just a bit. But one thing on the in the flexi cap fund, Raunak, with the fall that we've seen, have you and you're sitting on some cash, have you found up new stocks which have come off, which you've tracked, you like the businesses, but valuations were unpalatable and now have become attractive, or not really?
Not really attractive. So a lot of companies stay in our grocery list of what we want to buy at a certain price, but none of them are at a range where we say suddenly, okay, now we go and put all the cash into action and buy those companies. That time has not come yet.
Okay, all right. Now let's talk about the stress test, the mutual fund stress test results, which I think we should get tomorrow. Surabhi, tell us more.
Okay, so I'm going to try and simplify it as much as possible. I think most people know it, but for those who've kind of missed out on this, why are stress tests happening? Because there was a dialogue between SEBI and the mutual fund industry about the possibility of a little bit of excessive risk building up in small cap funds and in mid cap funds, because that's where all the money has been gushing in over the last couple of months. So then the body decided to get together and say, okay, let's do these stress tests. Actually, they are an ongoing phenomena in the mutual fund industry. Now, SEBI says the results must be made public so that investors can figure out whether they should be investing any further in small cap stocks, mid cap stocks or not. So what is a stress situation? That's the first thing. This is being described as a situation where there are two conditions. One, only 10% of market participation is available to a mutual fund scheme. When I try to understand what that means, what is 10% market participation, one interpretation was that instead of, let's say, 100 crores of total turnover, there's only 1,000 crores, there's only 100 crores of turnover on that particular day with that particular scheme. The second condition is when trading volumes are 3 times the normal, trading volumes on all the individual scripts that are part of a portfolio. So this is basically the definition of a stress situation. So now what do mutual funds have to do? They have to check how quickly can they liquidate the portfolio and basically meet the redemption requests that might be coming in on such a stressful day. So they have to declare how long will it take, the number of days it will take to liquidate 25% of the portfolio and 50% of the portfolio. Please remember, the end objective is very simple. SEBI wants to ensure that if it is a high stress situation and if investors are asking for redemptions, if they want their money back from these funds, they get their money. That's the sum and substance of it. Interestingly, these tests are not going to take into account the top most illiquid securities in a portfolio, which comprise up to 20% of the portfolio weight. So it's a little technical, which is why, Raunak, I wanted to come to you. And it's a two-part question. One, just explain to us this concept of 10% market participation. What does this mean? That's the first part of the question. And second, if you're not going to consider 20% of the most illiquid securities, then what's the point of the stress test anyway?
I think I don't have the right technical definitions for what you're asking, but what I can understand from what you just said is the concern is about liquidating the portfolio over a period of time when redemptions happen in a gush. So if it is a small and mid-cap kind of a company where anyway the volumes are very, very thinly traded as compared to larger companies, then that's the reason the stress test is used, so that people are generally aware of how much time it will take. And like you correctly said, this is an ongoing role anyway. So this is not something where suddenly the mutual funds have to comply to this and start testing the volume and redemption rates that they have seen. It's going to be an ongoing way. And I think for illiquid securities anyway, most companies have a large number of stocks in the portfolio. You can't have just a concentrated portfolio of a few stocks. So the portfolio along with that also can be liquidated over a period of time. So it's not necessary that just because the liquidity conditions are poor for these companies, you cannot liquidate them over a period of time. Of course, there might be a correction, the price might be different, but these are all hypothetical things. So technically discussing them is very difficult.
Well, we'll have to discuss them because the results are going to be out. I mean, some people say by tonight or maybe early morning tomorrow, and then we have to make sense of whatever these results say.
But is there some, they said that the number of days it takes to liquidate your portfolio, right? 25% and 50. Suppose we get a number, it takes 10 days, it takes 7 days. What would constitute a risky proposition for an investor? Is there some, broad, fence sort of a number that you can give us?
I don't think we can generalize that. So different people will have different time horizons of how they have invested in these schemes based on their investment requirements. So I don't think we can generalize whether 10 days is risky or 5 days is risky or 100 days is risky. So the first thing is we need to interpret them very carefully. It's not something where one number suddenly means something has changed dramatically. The nature of the companies will remain the same. The valuations people will pay will change based on their expectations. But I don't think the number can be given. Say for you, it might be 5 days is more risky. For me, it might be 350 days might be more risky. I don't know. So it's a different gauge.
No, absolutely. Yeah, no. Raunak, take your point 100%. And I think that is where the regulator is coming in from, that disclose this. So if someone has put in their hard-earned money in a small cap fund, they should know that if they want to get their money back, assume it's going to take at least 15 days if you want the whole money back, or if the fund suddenly has to sell. Basically, just it's another number that investors can use to gauge the level of risk and whether they're comfortable with it or not. So take your point completely. Thank you very much for joining us today and giving us thoughts on your portfolio and, of course, all the other trends out there.
So, there's another thing. There's in this entire thing, right, there's a bit of a, how do I put it, reflexivity involved, in the sense that this is to test extreme situations.
Yeah.
And say there is a crisis, right? First thing which disappears